folks. Thanks for joining me here today. Now, listen, what do we do in a market that's tough to find deals? How do we handle the ability to put our capital to work when we know real estate works, but we are up against so many headwinds? I'm joined today by Mark Ferris, Ferris Capital Group. Mark, thanks for joining us. We're talking about how to get our money to work in spite of all the headwinds we're facing here in Canada and real estate. Thanks again.
Yeah, great to be here, Patrick. Thanks for having me. Looking forward to this chat here as well. It's going to be a good one.
Yeah, well, we got a lot of ground to cover because, as we sit here today, we are kind of talking off air when we look at the challenges in the real estate market. JG and I happen to just do a kind of what's behind the curtain and a rein it in segment for the network. But ultimately, we look at what's happening in Canada. We've got rent controls that we're facing in terms of headwinds. We can't find inventory and cash flowing deals. Then we go to the bank and the bank says, no, you know something, 20% used to be okay. We want a little bit more money in now. And it's a rental property? Hold it. We got to change the rules of that game a little bit. So Mark, you're here to give us a solution to that, to a new opportunity. Number one, it's on the south of us here in your neck of the woods. But let's talk about first Ferris Capital. Just quickly, what is it that Ferris Capital does? And then I want to get into the details of what you're bringing to the table today to talk about.
Yeah, for sure. And you nailed it on the head. It's tough for Canadians, especially real estate investors out there. I mean, we had a really great run there, but the last couple of years have been tough. As you mentioned, rent control, finding great deals, financing's been another one. It's been really tough for Canadians. And, we found that for a lot of our investors, it was tough in Canada, and it was tough for me personally buying. And so what we do is, we started looking outside of Ontario, and we started looking down south. And we realized that down south, it was remind me a lot of 2008, 2009, early days of investing in Ontario. The benefits, though, is that down there we were not facing rent control problems, very landlord friendly rules, and the deals cash flow from day one. We love cash flow, and we love appreciation though too. And so what we do is we go in and we buy B-class assets between 1980 and 2010, value add. And what we do is we'll go in and renovate over a period of 2 years. The deals are cash flowing from day one. So this deal we have live that I'll be talking about today is in Charleston. It's 144 units. It's 97% occupied. And so we'll go in and we'll start with those vacant units. We'll renovate them. And every month as the leases come due, we'll offer a premium unit. Or market rent. And so some will take one of those two options. Some will decide that's not the right community for them anymore. And we'll go in and we'll renovate over a period of 2 years. And then we look to exit within a 2 to 5 year time frame, depending on the market when we feel it's right. And then we'll have another deal, value add deal ready to go. So we'll go in, renovate, flip these. Basically, we're flipping apartments, 100 unit deals, instead of homes. And we're able to help Canadian investors do it in a tax efficient, simple, easy button way.
Well, and you've been doing it for a while. I think there's a couple things that, for real estate investors, if you're listening and you're watching this, you obviously know that there's some opportunities in real estate. When we look at what's going on in the world today, and I'm not just talking about Canada, I'm talking about the global macro, even what's happening in the US, when we start to consider how do we actually put capital to work so that we can stay ahead of the inflation, of the rising costs, how do we put capital to work and also mitigate risk? What Ferris Capital and what you're offering, Mark, with your team is number one. Again, we're kind of effectively working around any kind of rent controls because you're not at the effect of those rent controls. You don't have to go for financing. It's this turnkey armchair deal that gets you great returns. Well, somebody may argue, well, I can get 5% these days, even 5.5% if I just park my money in the bank. And while that may be true, we're not talking about 5.5% returns. Your track record's much stronger than that. And I think the other side of it that we look at, when we are taking money and we're placing that capital, we have to look at the strength of the US dollar. And the fact remains it's going to stay strong. And I think this is also a place where there's probably a little bit of upside for Canadians that are putting their money that direction. Now, that's a little bit deeper conversation, and I don't want to go there necessarily. But I'm saying is that there's a lot of things that in these turnkey situations, not having to deal with the bank is huge. Not having to deal with landlord-tenant rules is significant. And then being able to place your money and get it outside of Canada, I think there's nothing wrong with that in terms of diversification. As a matter of fact, I think it's a smart strategy. So, Mark, how do you want to proceed? Do you want to start looking? First off, let me ask you this question before we look at the deal itself. Why Charlotte? Why are, I mean, you're 95%, I think you said, full. You're buying kind of a B or a C and an A, or a C and a B. What are you?
Yeah, Charleston. So Charleston, South Carolina. I'm gonna hold that question because I'm gonna actually talk about it in the presentation here.
Beautiful. Yeah.
But it's a very good question. You know, why are we buying these markets? I'm going to dig in not only to the market, but I'm also going to dig into the deal. And give you a high level snapshot. Now we'll have a separate webinar that goes even deeper into this particular deal. But what I'm going to do here is I'm actually going to explain our business, our overall. I'll give you. There's going to be a lot here, Patrick. I think there's going to be a lot of value for the listeners here. We're going to talk really about quick market snapshot, why we think apartments are strong, and then we'll talk a little bit about our business plan on how our business plan is to double the equity that is given through a value add approach. I'm gonna explain that here, and then at the end I'm gonna give pretty much like a high level snapshot of the deal that we have, which is we're actually about 3/4 of the way filled on this. So there's a window of opportunity here but if it's not on this deal, in the future deal, at least your listeners are going to have some really good context of the types of deals that we go after. This one's filling really quick. This one in Charleston's really strong deal. So I'll go through it all. So if it's okay with you, I'll kick it off here. Why are we here? I mean, why do people invest in real estate? And for me, I mean, these are some of the major things that keep us up at night as real estate investors. I've heard a lot of concerns. This is just under the surface, right? Will I have enough money down the road to retire? Right? Great question. Concerns on, facing your spouse that you didn't provide for your family, seeing your potential, maybe your parents are suffering and they need financial resources to help look after them, or your kids, putting them through university, right? Never living a life that you dreamed of, stuck trading time for money, and not doing what you want, when you want, with who you want to do it with, right? And so for me, these are major concerns that we have. And for me, I believe real estate is the answer to it. From a financial standpoint, it's made 90% of millionaires. Real estate has been the asset class. So it's like, why recreate the wheel? Do what works to be able to handle those major concerns, those financial concerns. Why else is real estate strong? It's an income generating physical asset. Inflation hedge, as they start printing more money, rents will rise in correlation with the inflation. So it's a great hedge there. You can leverage it. So you can put $1 down and you can buy something 5 times greater through debt or financing. There's limited supply of these types of buildings. You can invest in real estate passive in a stress-free amount. So you don't need to deal with tenants. Rental demand is increasing. We're becoming more of a renter nation. I'll be sharing a slide on that. You can benefit through depreciation, where you can lower your taxes, where it can be very tax efficient. And you can protect your downside through the big 3. We call them our 3 golden rules when we invest. We only buy deals that cash flow. It needs to be able to return 5% distributions to our investors. Second one is adequate cash reserves. And the third one is we only buy deals where we can fix the debt in it. So, the mortgage we lock in long term, so that if rates go up, we're not going to be underwater as many operators are today. It's always going to be in demand. And you know what? If you do a good job in real estate, you can make an impact in people's lives, the tenants, right? And create a great community. So the big 5 in real estate: cash flow, mortgage pay down, tax incentives, natural appreciation, and forced appreciation. Now, forced appreciation that's what I'm really going to dig into. Yeah. That's what we really like. We like the forced appreciation because we're not relying on the market to go up. Okay. And I'm going to be talking about that. So why don't more people invest in real estate? Well, it can be complicated, not sure how to find good deals. They don't have the team to be able to execute on it, don't have time. I mean, most of our investors, they're very expensive per hour. They're doing extremely well. Making money isn't as much of a challenge for them as getting great returns. It's just they're busy making money. They don't get around to getting started. It can be overwhelming. And last but not least, the tenant headaches out there. So if real estate's the bridge to handle those major problems, right? Those major concerns that keep us up at night that I shared with you at the beginning, real estate's the bridge, but there's some reasons why you don't cross that bridge, right? That I shared with you earlier. So Fair's Capital is really, we want to come under that, under real estate and support it so that you can easily walk across in an easy button approach. And why do we like apartments as our asset of choice? Well, it's a safer investment. And the reason being is because we buy B-class assets that are already tenanted in. So there's tenants. So we basically flip it while we're cash flowing it, right? So it's not like a single family where you're renovating it and you have no rent. Well, these 100-unit buildings, you can renovate 5 units a month over a period of a couple of years, and you're still cash flowing. So it's safer. There's lower vacancy risk if 1 or 2 tenants move out. The reality is that's okay. You still have 98 others paying. Apartments are rare and they're increasing in demand. There's more operators getting into the space. And the reality is that we only buy B class that have a value add component that aren't operated strong. So we got to look through more than 100 deals to find one, and then we have to negotiate it as well. So our odds of getting it are very low. When we do get one, they're really strong. Economies of scale with expenses, one place to look after instead of 100 different roofs, right? So you get deals with contractors when you do things at scale like that. Predictable value add projections. For every dollar that we increase net operating income, we can increase the overall value of the building by 20. So and that's what I'm going to be talking about, and a bigger opportunity to help more people. So
and Mark, can I just interrupt right at this point, right there? I just want to shine a light on something. What you just said is for every dollar that you increase, you increase the value of at 20. So when you think about and start to do the math on that, and you've got let's say 100 units as an example, if you get rent up $50, $75, $25, $100, and you start to do the math on that, the numbers get very, very big. So for those of you who are investors that aren't familiar with what you can do in the multifamily space, the numbers get very big very quickly, just even based on what you said around that. And then what I don't want to step over as well on that point is that you guys have done this before. So the efficiencies of turning units over and doing that in a cost-effective way, not just in the hard cost, but in the effective in terms of the time frame that you do it within, is really, really powerful as well. So you're maximizing that ROI, that 1 to 20 kind of rule, if you will. You're really maximizing it.
Thanks, Patrick. You nailed that. And that's where, further on in the presentation, I'm going to share an actual example so Beautiful. that everybody that's watching, you're going to really it's for me, when I saw this is where it was like a light bulb moment for me. And I hope it's the same for you as well. But for you, those of you that are data driven, these next couple of slides will be helpful. I mentioned earlier about we're becoming more of a renter nation. I mean, that's right across North America, US and in Canada. The interesting, if you go to Europe, I mean, most people rent, right? But home ownership has always been very easy here. But the reality is that home ownership has become more expensive. Right now, it's 57% more expensive to buy a home than to rent one. And you can see the gap. I mean, it's more expensive today than it's ever been. And then when you compare what multifamily or apartment investing compared to say stocks, I mean, you don't get that same kind of roller coaster ride. Like the dotted line is a consumer price index. So basically it's the cost of goods, right? So with inflation as it goes up, the reality here is that net operating income for apartments is steady, right? It trends above inflation, but you can see S&P 500. I mean, geez, you're waking up one day and you're like 30% of your portfolio is gone. Yeah. I'm not a fan of that. I like slow and steady, right? The other thing is that, we're in a, why real estate overall? I mean, we're 4 million households short. And so what's interesting, and I know you talked about this quite a bit as well, Patrick, why is that the case? Well, in 2008, there are a lot of developers that got wiped out. And so there's still population growth happening. And the reality is we got behind. There were a lot of developers that they took them a bit to get back in the market. And then 2021, that further exacerbated the issue because you had supply chain issues and a lot of developers put their projects on hold again But yet again, we got, immigration, people are moving in. And then you had, of course, interest rates in 22, 23, they spike. Developers, they're just putting their projects on hold, a lot of them.
Yeah.
I mean, they're doing a lot of purpose-built rentals right now. They're building, but like, single family. So it's just, there are more and more supply and demand issues. And so for me, the reality is you want to be able to invest in a place where there's trends, where the amount of clientele, like people that are renting, is growing. You want to be able to buy an asset that they're going to go after, that they're going after. And so that's part of the reason why we're supply and demand issues, is because of the, a lot of developers are putting their projects on hold, right? So then, where do you invest? So for me, what we started doing is looking around the US and like, where are places that are affordable? And this slide shows pretty good comparison between, say, San Francisco and Charleston. Like, you can live almost on half the income in Charleston as San Francisco. Mm-hmm. So this is why a lot of employers move to these areas, because they don't have to pay their employees as much for cost of living, right? And this just means there's more upside opportunity for growth to happen, right? And so they have more money in their pocket to be able to pay, good amount of rents. So we have another presentation that talks about our full 10-step process, but I'm only going to focus on one. And this is like the dessert of the entire other presentation that you guys are going to get to see here. And so this is the value add approach. Talking, Patrick and I were talking about this earlier, about for every dollar you increase the net operating income, you increase the value of the building by 20. And here's the ratio. Here's the formula, basically. If you can increase $100 of net operating income of, say, rent per month, okay? So if you increase any unit by $100, it increases the value of the building by $24,000. So this is based on, Patrick, based on a 5 cap. So, it's a little higher than that in a lot of these markets that we're buying, but we're just using 5 as a way to kind of showcase. And for those that are watching, as cap rates go up, the values of the buildings go down. But 5 is a pretty good number to be able to do this comparison, just to give you an idea of how the formula works with the income approach. Okay, so these buildings, they're valued based on income approach, not on direct comparison like single family properties, where you take something that's sold across the street and compare it to yours and 3 others in the area. It's based on how much net operating income you have, and they divide that by the going cap rate in the area. So it spits out a value. So it's very predictable, we can call it. So let's take this example. This is a 300 unit deal. You buy it for 38 million. Okay, you bring 19 million in equity to the deal. Now this includes all of your capital expenditures, your renovations, your expenses, and your reserves. Okay, so you bring 19 million, you raise 19 million in equity to this deal. Okay. So let's take this example here, kitchen. Okay, so we know by shopping the comparables that we can get another $150 per month per unit if we go in and renovate. Okay, so we realize that this building that we're looking at, this example, 200 of the 300 units are classic units. They need renovation, and we walked all the comparable properties and we verified that we can get another $150 per month on these other properties. Plus, in this existing property, they're already getting $150 more for renovated units. It's proven out. Okay, so based on that, if we go in and renovate these 200 units over a period of a couple of years, we're increasing each unit. Every one that we do, we increase the value by $36,000. If we do 200 units, we increase the overall value of the building by $7.2 million. Okay. I'll give you a second to let that sink in. That's $7.2 million. That's forcing. This is not based on natural appreciation. This is just based on increasing the net operating income. Second, let's start stacking. This deal also has about $100 under market rents. The existing operations, the owners, they've been doing a bad job, we'll call it, and they have not been pushing rents. They've been getting a little bit complacent. So we validated for 250 of the units are $100 under market value. We go and push rents over a period of 2 years and get that to market value. That's $6 million that we've created by increasing $100 per month on 250 of the 300 units. Okay, let's go to washer and dryers. They have 200 units that have the hookups, but they don't have washer and dryers
Wow.
connected, right? So we validated we can get in there $50 a month per unit. That's $12,000 per unit, or $2.4 million by just putting in washer and dryers, and 200 of the units. Okay, I have a little dog, Bella, little miniature schnauzer. I would pay $125 if somebody fenced in my yard if I was on the main floor or
All
ground,
day long. Yeah.
right? I love my dog, and so do a lot of tenants. So we know that, okay, 50 units are conducive to be able to put these fences in. So, we'll approach the tenants and we'll say, listen, $125 per month extra, and we'll install the fence. Well, boom, $1.5 million for doing that to 50 of the units. Parcel lockers, 300 units, $9 extra a month, 648 grand it adds. Valet trash, people don't want to walk to the corner, we charge $20 a month. We pick their garbage up at the end of the day. For 300 units, that adds $1.44 million. So let's stack it up. 7.2, 6 million, 2.4, this all stacks up to a grand total of over $19 million. So you have your original equity, plus you double just by forcing the appreciation. This is not including natural appreciation. This was the light bulb moment for me back a number of years ago. And this can be a real light bulb moment for you as well. This is how we're able to deliver over 20% annualized returns with more potential upside from there, depending on how well the market does, because we're not relying on the market to get a home run, like the natural appreciation there. We're forcing and we're finding deals and we're forcing it and going from there. So what do you think of that, Patrick? It's pretty incredible.
Well, it is incredible. And, I want to just point out something to, those listening and watching this, is that, over 25 years that I've been part of the RAIN community, investing in real estate, this is not pie in the sky. These numbers get really big, really fast, but this is a proven system of doing this. I mean, you've done it. I've seen others do it in different regions, but the math and the model work, and it works time and time again. And for those like businesses like you who know what they're doing, who've got the experience to do it, they're turning deals like this all the time. And I mean, it was really part of why I was excited to have Ferris as a trusted partner of RAIN, because this is something that you guys do. And when I look at what investors are trying to get to, which is, I want to get my capital to work, I want great returns on my investment, but I don't have time, I don't have the energy, I may not have the financial wherewithal to go to the bank and get a mortgage, I don't want to deal with tenants. This is to me, it's like a no-brainer solution to all of those things. So
yeah,
yes, I love it.
Yeah, 100%. I found, Patrick, the operations side, what's one of the most important skill sets in any business when you're especially doing this, is focus attention on the details. It's all in the day-to-day, focus attention on holding people accountable, and not letting people push you around. You have a business plan, you got to execute, and the excuses just don't cut it. You're dealing with big numbers. You got to hold people accountable. And that's one of the things that the team that we've built, everybody knows what they need to do. And we all know our responsibility, and we execute as a strong business. Right. So, well said. So, yeah. Okay. Well, I'm going to actually share a live deal here to.
Can I go before you share the live deal? And I'm sure somebody will go, Patrick, quit talking. Okay. But I want to know something that you said, operationally, when you look at your team. So when you tell me a little bit about how do you handle the on-site, because I know somebody who's a little bit more savvy, the question they're going to ask is, well, what are you doing on site to your point, to manage that property or to manage the operations?
Yeah, well said. So first off, our asset manager, Georgia Patron, has 20 years experience working and has gone full cycle on multiple deals in this market. So as for working with property managers on site, like, we have our hands on the pulse of, not only in the hiring, because we validate and ensure that every single staff member that's on site, we go through and sign off on and interview. And then it's really just about the day-to-day reporting. You know, those daily, like you can have a 5 to 10 minute quick huddle reporting on the key metrics and holding people responsible and accountable. And then there's pop-up visits as well along the way. So for us, you know, sales is one of our strengths. Like we built one of our other verticals. We have the largest real estate team in Canada, and sales is what we know. So when a new tenant comes in, what's the experience from not only online, but then coming through driving up? What's the experience? What's the first thing they see coming in? What's the community core values in the mission statement? What's the presentation to be able to show our value and what differentiates us? What's the process for walking the tenant through and be able to pre-answer their questions and make them feel comfortable to bring them back through, sit down to be able to have an application sign at the end? There's a sales process there.
Mm-hmm.
And so that's where, for me, the conversion rate is something that this is what we do on that end. And so it's a combo effect with our entire, we have a full-time team of 7 there. And then we work alongside in partnership with our property management, but we're very hands-on. We're not a fan of just, okay, it's in the property manager's hands, they got it. No, that like we got like this deal, we have $12 million of equity that we have there. We have a vested interest on driving operational excellence. So we're very hands-on with that. And if the property, you know, we've actually, as we went through and interviewed some property managers weren't okay with that. And so, you know, we selected one that we believe is, you know, that they were good with that. And so, you know, we're very happy with that, you know, with that mindset and with the execution side.
I love it. It's such an important part in my world. You know, when I'm looking at Ferris Capital and what you guys do, this particular project, I want to know how it's going to operate. Is this a set it and forget it? And it's not. And that's really important because not everybody is in the trenches, hands-on, having a team, being conscious. I mean, you're literally, when you think about the size of this particular building and the buildings and the project, I mean, it really is an operational business that has to be looked after. And, you know, given the goal, it's going to take some real concerted effort and a real kind of focus to make sure that you're maximizing ROI. And you're going to do that through looking after your clients / your tenants and managing it operationally really well. So I wanted to shine a light on that. So thanks for taking the time to do that. I will let you carry on and won't interrupt you again for a minute.
No, actually, you said a word there that I really like. That's a good transition into this deal, because that focus there is something that, I mean, the existing owners of this building, they're a couple of doctors, and they had some other investors, but they got tired of the operational side, and they said, you know what, we just want to get out of the business. And so they're liquidating a number of from their portfolio. And so we got this at a 27% discount because they're operating at more of a, you know, kind of part-time, whereas this is all we do. This is full-time operational. So we love the detail. And if you create a system or process around it, then it's just, you know what, what's the process for that? We just follow that, and then we learn from that. And so every single deal that we do, we get better and better and better. We don't know everything, but we definitely improve. And so that focused attention is something that the existing owners in this, they no longer wanted to do because there was more of a part-time. But that set the stage really well for this particular deal. So this is a 144 unit value add deal. There's 272 units. They're about 20 minutes apart from each other, just outside of Charleston. We got this at a 27% discount from the peak of the market. There's $320 lift opportunity per month per unit on this. So you know how we were showing the 1 to 20 ratio there.
Mm-hmm.
This has $320 per unit. You could imagine per month. So that's a significant lift opportunity on this. So we're very bullish. And to put a cherry on top, there's a 4.12% first mortgage that we're assuming on this deal, which is you'll never get that in today's market. That's interest only for 7 years. I mean, it's incredible.
Yeah.
So that sets the stage. Now, you had asked me earlier, you know, why Charleston? Well, starting with the state of South Carolina, super rich history. If you haven't visited, it's actually quite a really great spot to visit if you want to go for a few days. South Carolina is now the second most popular destination for movers in the U.S. This is a U-Haul report 2022. Landlord-friendly state. There's no rent control. Super affordable. Better quality of life. Low property tax there. Diverse economy. So it's actually, if you look on I'll show you a slide here that shows the diversity in the employment. And companies they've committed to invest over $10 billion in South Carolina. Charleston, some of the key metrics there: job growth expected to surpass the national average by about 2.5% approximately. It's forecasted to grow at 3.7%. The national average is 3%, so it's growing faster than the national average, which you want. Unemployment's less; it's almost half than the national average at 2.1%. And there's 1,200 tech companies with about 9,200 employed in that. So there's just a lot happening there in a great that's super valuable for real estate. This is what I want to see when I see stable and diverse economy. If one of these industries go down or there's a lull, that's okay. We're not going to lose half our tenant base. Mm-hmm. And so it's an insulated market. That's why we like it. So you can see here, so Monk's Corner and Goose Creek, here's our brand, actually, Ferris Residences. This is one of the things that we're very adamant about when we go into an asset. We go in and rebrand it, and we change the feel of it. And so they're 272 units, gorgeous. They're like 12 to 1,300 square feet. Wow. They're big, 2 to 3 bedrooms. There's no 1 bedrooms, 9.5-foot ceilings, 4-inch baseboards. They're really nice. It's just they're all original classic units. So they need a facelift. So just kitchens, bathrooms, flooring, paint, nothing major structural, which is exactly what we want. I'd mentioned there we bought this off market. It didn't hit the open market. This is a broker relationship we had. 27% off the peak of the market. It's 2003 and 2008 built, so it's newer construction. This area is very strong income with 28 to 30% rent to income ratio, which Toronto is like 60%, which is it's incredible in this area. All the units we can go in and renovate, $320 lift opportunity, and we have that first mortgage at 4.12%. We're getting a supplemental on that, which blends out to about 4.93%. So it's still super low. Highlights here: 23.5 million we bought for. Project costs, including all renos, comes out to just over 5. And you can see we project to create 12.76 million based on that forced appreciation concept that I talked to you about earlier. And this is 97% average occupancy right now. So I mean, it's already cash flowing. We could do nothing on this, and it would still be a great deal. We're projecting 20.8% annualized returns. Part of the benefit of vesting down there is that we're actually able to give monthly distributions to our investors or mailbox money. So 6.5% is the average over the 5-year hold period. Equity multiplier just over 2. And the hold period on this is 2 to 5 years. We say that because our reno business plan is approximately about 2 years. We are looking to sell after that period. It's going to be really up to the market if we feel it's a strong market or not. And we also want to have another value add deal ready to go for the investors that want to say, let's do it again, which most of them will after they see the returns. Yeah. And then the minimum investment, so it's $100,000 US, is for accredited investors only. So if there's any questions, you don't need to do anything to be an accredited. It's more just of a threshold of income or net worth, but we can talk about that if there's any questions there. This just shows a breakdown of the year over year. You can see on the top here the cash flow. So if there's $100,000 US invested, the first year is 4,600, second year is 5,500. This isn't cash flow. And then year 3, once you're done the renos, you can see it jumps up in year 3, 4, and then 5. And so what happens when we go to sell? And so Patrick, just so we're clear with everybody, that these distributions is return of capital. So at the end of the year, we're declaring it, but we're not paying tax on this until we sell it. And then when we sell it, the full gain. So we take your 100,000 that's invested, and now you have 204. So your overall invested up, your capital gain is 104,000 and change approximately. So you're paying a capital gain at the end on this 104,000, which is really the best kind of tax you want to pay.
Of course.
Right. So it's
Yeah.
very tax efficient for Canadians, and you invest in a Canadian limited partnership, you get a Canadian tax slip at the end of the year. Very efficient from a tax standpoint, and easy button as well. You don't need to do any double tax returns or anything being investing in the US.
Beautiful.
Okay. Yeah, I mean, here's a few testimonials. Tom, he loves the fact that we have an accomplished team. Mary likes the fact that we've just been super upfront with the information. Amy from Melton loves the fact of the distributions, and then Patricia and Chris there. We've been the first class service is the value that we really focus on for our investors. And Patrick, I'm sure everybody that's watching it there. Maybe you can put a link to learn more about the deal, and then also you could share my my Calendly link.
Yes.
To be able to book a one-on-one call with me. That's really the main goal. If there's a question or you want to learn more, just book that one-on-one call, and then we can get you, all your questions answered there.
Beautiful, Mark. I appreciate this. And folks, I can't stress enough that when we look at the world of real estate, what's happening, I'm always looking at what's going on economically, both sides of the border, by the way. Interesting that you bring that up. One of our RAIN members, very astute, took our RAIN Gold Mine scorecard, put it into chat
GPT.
AI, into chat GDP, put it in there and said, name all of the US cities that fall within the parameters of this gold mine scorecard, all of the parameters of that. And I went, that's freaking genius.
Right.
Anyway, Charlotte showed up on his list of stuff as well, by the way, just so you know. And I thought that was really, really great. How do you tap into technology? Yeah. And it's just a confirmation of where you guys are and what you've done and why you're going to the US. And I think it's a great opportunity, again, for investors who are tired of the headwinds of financing, finding deals like cash flow, all of the things that are there, but are still wanting to get their capital to work in real estate. This is a great opportunity. So thanks for doing that, Mark.
Thanks, Patrick. Yeah, appreciate you and your insight on this as well. So
folks, again, we'll put everything in the description below. Reach out to Mark or his team and take a look at this deal. I think it is definitely worth your time and energy to investigate a little bit further. Mark, thanks for joining me.
Thanks again, Patrick.